Now we turn to problem set 9. Hopefully you've looked in the notes, read through the notes, the, the online PowerPoint presentation, and maybe even the class discussion, depending on when you get to this problem. But this is economic value added, one of my favorite topics. If I were running my own firm, economic value added is the way I would assess the firm to figure out if I was doing a good job managing the firm. It's also known as EVA. We used EVA when I was at UTSA. I had a former EMBA student that part of the class we had a project where they could actually, if they wanted to take one of these applications and apply it to their own company, and he had a small sole proprietorship business. So we used EVA to assess his business, and what we found was he was adding tremendous value. It was a really very profitable, very value-adding business. His biggest issue was scaling the business, getting it larger, putting it out, getting more vendors, more locations. But each location had a high EVA. It's a very good way to think about a business and how it's being run. You might ask your firm and see if they use EVA, and after you see this exercise, you might want to look at the details. This is very similar to what we've talked about in previous applications, such as the weighted average cost of capital, set 7, where we simplified it somewhat, but if you understand the simplified approach, the only difference from that and what a firm would do in detail is just the details. So at UTSA, when UTSA used EVA, the spreadsheet was massive. It would go on for 80, 100 sheets, but they weren't doing anything different than what we are doing here. It's the exact same operation, just a lot more details. So if you understand this approach, can build it. You have a couple of problems. We'll set this first one up, and then you can use it to build the second problem. You should have a good understanding, a strong understanding that you could sit down with your company and assess what the EVA is. Or if your firm doesn't use EVA, you will know enough to go and ask them, have you thought about EVA? Could we look at EVA as an exercise to see if that's something that would help us manage the firm better from a financial standpoint. So let's think about EVA. So let's set up what they've already given us. They have revenue, expenses, and then they have interest expense. You notice we're ignoring taxes, which is fine. And then we have the accounting net income. So I'm going to give myself a little bit more column here. And I'll set this up in B3 as my first number. You can notice the revenues is 24 million. And let's change our formatting to dollars with no decimal places. 24 million. Their expenses are 22 million. Interest expense, well, let's set up the interest expense. So we'll set up down below cost of capital. I'll start it in row 12. I think that gives me enough room. Cost of capital, we have cost of debt. And we also have capital, I'm going to put this in C11, capital employed. And the rate. Let's put all that in there. I'm going to bold and center these. So capital employed, that is how much do you have invested? And so capital employed, you can see she invests $5 million of her own money, so that's cost of equity. So capital employed for her is $5 million. Again, that's the dollar amount, so we'll put that in dollars. We don't need decimal places. And so $5 million of her own money. She believes this is about as risky as investing in the stock market, which requires a 22. This is more risky than the stock market, which makes sense. With a small business, you need a higher return. We'll talk about this some in class. You need a higher return if you're investing all of your money in one small business you need a really high return to compensate you for risk. So she's using 22%. So 22%. And then the cost of debt, the capital employed on debt, you can see that she borrows $10 million. Let's put a dollar sign there and no decimal places. And the rate there, the bank charges her 10%. That might seem high, but this is a very risky business. And so what is their cost of capital? I guess we can put that over here, cost of capital. So for debt, it's the 10 million times the 10%, or $1 million. You can see that's the same thing as is given in the problem, $1 million. Good thing that's the same, or else we'd have some disconnect. And then the cost of equity is $5 million times 22%, or $11 million. Oh, it's at $1.1 million. I can't do the math. All right, so I'll put that formula over there on the side. You just multiply across $10 million times 10%, and your total cost of capital it's just the sum of those two. Your total capital employed is 15 million, and so your cost of capital, you can just take the 2.1 million divided by the 15 million. You can see that your cost of capital is 14%. All right. So interest expense, if you'd like, you can just do the equal key and go down to this number, but then make sure it matches what was given in the problem. And in your accounting profit, you just do equal revenue minus expense minus interest expense, and you get $1 million. Again, that matches what we have here. So what we're going to do with economic value added is say, let's start with their accounting net income, and we'll add and subtract things that are not economic. We'll take the non-economic things out, and so they're ending up with just an economic income. So let's put our adjustments here. So the one adjustment we have that's accounting related is depreciation. You can see in this $22 million, you see the asterisk there, it includes $400,000 in depreciation. That's a non-economic item. We're going to add that back. And if you want to be real clear, you could actually put it in your description, add back depreciation. The other thing we want to do, the accounting profit includes our cost of capital. What we're trying to do with economic value added is we want to look at economic profits without cost of capital. So we're going to add back interest expense. Make this column a little bit wider. Add back interest expense. So there we just go up and reference the interest expense. So the $400,000 given in the footnote. The interest expense, you can see we've calculated that it was given in the problem. We calculated it. We put it in the problem. So now we have our economic profit. Our economic profit is just our accounting profit plus depreciation plus the interest expense. And so that's all the adjustments that we need. What I recommend you do is click on the 11 here, right click and insert. So you insert a row. So we have an extra row there. I thought I had enough rows, but I didn't. So there's my accounting profit, and here's my economic profit. So our economic profit, and this is true for most firms, our economic profit is much higher than our accounting profit, mainly because we're adding back depreciation. Now you notice that in those expenses, there's $1 million in salary that she pays herself. I put that in as a red herring. It doesn't mean anything. There's no reason to adjust that out. That's, to me, somewhat of a opportunity costs. If she weren't spending all her time running this business, she could get a job somewhere, and she's a high-paid person. So if she's working somewhere else, she can make $1 million. So she might as well pay herself $1 million. This is not a return on her capital. This is a return on her time. So she's paying herself $1 million because of all the time she put into the business. The next question is, we take all the money she put in her business, will she get a return to compensate her for her financial capital? But this $1 million is compensating her for her human capital. And so we can leave that in. That's an economic cost. She should pay herself $1 million. That's paying her for her time. And now we're going to see if she's going to get compensated for her capital employed. All right, so we have the economic profit, and we have the cost of capital. So for EVA, we just take economic profit and we subtract cost of capital, and that gets us our economic value added. So our economic profit is 2.1 million. I'm sorry, economic profit is 2.4 million. Our cost of capital is 2.1 million. So our economic value added is $300,000. And it's positive, so that's good. Anything greater than 0 is good. That means she's covering all her costs of capital, the full 2.1 million. She's covering what she owes the bank. She's covering what she needs to make to compensate her for risk, and she's getting an additional $300,000. So she is running her business very, very well. Let's look at this again, but in percents. So we'll instead of calling it economic profit, we'll refer to it as return on invested capital, also known as ROIC. And so that is going to be what? It's going to be our economic profit divided by our cost of capital. We'll do that as a percent. 16%. Then we have our cost of capital again. We already know what that is as a percent. It's this 14%. And that gives us what we call the EVA spread. So you have economic value, which is your EVA in dollars. EVA spread is your EVA in percents. You just take your return on capital minus your cost of capital, and you have 2%. So that $300,000, if you want to check it, you just take the $300,000 and divide it by your capital employed, and you should get 2%. It should give you the same number. So there's our EVA spread. So your assessment is she is adding value over and above her cost of capital. So her firm is very valuable. She only needs to make 14% return to make everybody happy, cover for risk, make the bank happy, but she's actually making 16% plus she's paying herself $1 million salary on top of that. So unless she's spending 80 hours, 90 hours a week running her business, sounds like she's in pretty good shape. So let's go back and again, let's highlight the things where we have to input a number. So you want to input the revenue and expense. The interest expense, I think you're better off calculating it. So you need to add back the depreciation. You get that out of the problem. And over here, the capital employed, you have to input that. And those rates, you need to input those two numbers. Everything else is a formula. All the way down, everything else, you notice you don't really need much. There's not much input into this problem. It's just 1, 2, 3, 4, 5, 6, 7 numbers. So 7 numbers from up here. You input those, and that's everything you need. So straightforward problem, but again, step back after you do the problem and think about what you're doing, and especially use this as an opportunity to go to your firm and ask either, can you show me how we do EVA here? I'm not even sure if USAA still does EVA. We did it when Bob Davis was CEO. I don't know what Joe Robles did or Stuart Parker or now Wayne, but they did it when I was there. If your firm doesn't, I know Rackspace definitely uses EVA, or at least did before they were taken over here recently. So there are several firms. General GE, which has gotten really bad press recently for really struggling financially. They were a big EVA type of firm. So it's still popular, but not every firm uses it. It's not quite as common as doing the cost benefit analysis the way we did it. That's very common in most firms, but EVA is not. So ask the question, how does our firm do it? Or if your firm doesn't do it, ask the question, have we considered using EVA to assess the job that management's doing in this firm? So there's the EVA problem, very straightforward. Should be very easy to set up the second problem for EVA.